I'm often asked by veterinarians and practice managers if our revenue goes up or down by X percentage, how does that impact our profitability? Is it a dollar for dollar change? Does my profitability improve by the same percentage as my revenue did? And then what happens if my expenses go up or down? How does that impact my profitability? So a specific example would be in a situation where the practice's average doctor transaction improves by $10. They increase it by $10. So the questions resulting from that are, all right, how much does our revenue go up because of that $10 improvement in our average doctor transaction? And then how much of that improvement goes to the bottom line to profitability? On the expense side, if our variable expenses go down by $15,000 and we hire an additional technician, so our staff compensation goes up, how do these changes impact profitability? Now, you certainly could calculate those changes manually, but if you wanted to go through a series of what-if scenarios, it could get cumbersome. So we developed a revenue and expense change worksheet, an Excel spreadsheet, to do the calculations for you. So on your screen, when you open this file, you'll open to the instruction tab. So you can see this is what your screen would look like if you're working with this program. So this is just the basic instructions. It's a pretty intuitive program, so it's not real difficult to use. So basically, the basic instructions are to use the tab keys to move from one cell to the next, and any cell that is highlighted in blue means that that's available to input data in. If the cell is not highlighted in blue, it's white, it means that there is a formula built into the program, so you don't want to type any information into that cell. And the program is protected so that those formulas are not easy to accidentally overwrite. So basically, you're just following through on entering the information as per the instructions in the file. You will need to know your staff to doctor ratio, so we've given you the instructions for how to calculate that. And then we've given you instructions if you get any error messages, what to do about that and what that might look like. And also note that there are multiple pages within this worksheet. So the first page, which is what we're on right now, is the directions or the instructions. The second tab in the file says revenue change, and this is the worksheet that you're going to use if you want to determine what happens to my revenue if something changes, if my average doctor transaction changes, if my client numbers change, if my client visitation changes, what is the impact on my revenue and then on my profitability. The third tab in the file is expense changes, and again, this is just a worksheet that you can use to work through the what-if scenarios on the expense side. And then if you want to look at the combined effect of both the revenue and the expense changes, your what-if scenarios, then the third, number 3, the combined change, is the spreadsheet or the page that you'll use to see those numbers. When we get to the actual worksheets, you'll see these buttons at the top on 2 of them, the expense change and the combined change. So basically, you just have to answer yes, no, or delete all the inputs that I've done so far. I want to start over again. Then the balance of this is just a disclaimer for the usage of this spreadsheet. So let's walk through how we use this worksheet. It's kind of a fun little thing, and it makes playing around with these what-if scenarios a lot quicker and a lot easier to do. So let's start with the revenue changes. And so what I've done is click on the revenue change tab in the spreadsheet. And you see we've got some blue cells. That means I've got to enter information into these blue cells. So I'm going to assume in my sample here that we've got a 5 full-time equivalent doctor practice. And the staff to doctor ratio in this practice is 3.5 to 1. The current average doctor transaction in this practice overall for the practice is $122. And those are the invoices that the doctors are directly involved with, that they get credit for. The number of doctor transactions or number of invoices in this 5-doctor practice is 14,900. And the number of active clients that this practice currently has, the total number of active clients, is 5,500. Now we do define active as somebody that you have seen at least once in a 12-month period. So this client has been into the practice for medical purposes at least once in a 12-month period. So now that I've entered that preliminary basic information, you can see that the client visitation rate for this practice is 2.7 times. And we got that simply by taking the number of doctor transactions and dividing it by the active clients. So the formula is written out there, but the formula is built into the cell, so it automatically calculates for you. So if you don't know what your current client visitation rates are, that would be another use or way to get this information is by utilizing this worksheet. Now we also have to enter information about your revenue and your expenses before you start through your what-if scenarios. So for this practice, their revenue was $1,996,000. And their variable expenses were $511,000. That gives us, or that represents 26% of total revenue. Their fixed expenses, which are more your administrative overhead, those were about $165,000, or 8% of revenue. The staff compensation, the non-doctor staff, $492,000. or 25% of revenue, and then the facility expenses about $212,000, or 11% of revenue. So right now in this practice, the amount available for doctor compensation and reinvestment in the practice is $616,000, and or 31% of revenue is left to pay the doctors and to reinvest in the practice. So we refer to that also as your profit to revenue ratio. So let's work through some what-if scenarios. What if the average doctor transaction in this practice improves or increases by $10? What happens to revenue? If the average the result of that is if the average doctor transaction increases by $10, revenue will increase by $149,000. So we take the number of doctor transactions times that $10 increase, and basically that's how we get that 149. Again, you can certainly do this math manually, but it's a lot quicker and easier to just let the program do it for you. Our second what-if scenario is, what if our active clients grow by 500? So instead of 5,500 active clients, we've got 6,000 active clients. If that occurs, our number of doctor transactions will increase by roughly 1,300. That is going to have the impact of growing our revenue by about $179,000. And if client visitation increases by 0.3 times, in other words, we go from the 2.7 to 3 times a year for medical purposes, then if client visitation increases, doctor transactions will increase by roughly 1,700. and revenue will grow by about $218,000. So these three changes would have a positive impact on revenue of $565,000 total, resulting in an increase of $313,000 in the amount available for doctor compensation and reinvestment. So if we go to this section of the worksheet, after the revenue changes, you can see that the revenue went from almost $2 million up to $2.5 million. The variable expenses are the items that change in direct proportion to the number of patients you see. So we increased the number of patients by increasing the number of active clients, and we increased the patient visits. So both of those things would have an impact on the variable expenses. They would go up, but they're not going to go up in the same at the same rate as before. So you do get some economies of scale, because not all of that increase this ADT increase is going to come from increased usage of inventory. So as a result of this revenue change, even though yes, our dollars of variable expenses went up a bit, as a percentage of revenue, it fell much more in line. Fixed expenses, again, we assume there's some increase in fixed expenses, because if you're seeing more clients, you're seeing more patients, and you're seeing them more frequently, some of your overhead is naturally going to go up. So we did assume in dollars that the fixed expenses are going to go up a bit, but again, you get some economies of scale. It's not a direct dollar for dollar increase. So now the fixed expenses represent 7% of total revenue. Staff compensation, again, we assumed that there would be some increase if we're seeing more clients and more frequent visitation. Very likely you're going to need some additional staff. So the program factors that in. So the staff cost still represents 25% of revenue. The dollars have gone up. The facility expenses we didn't need to change because we had excess capacity in the facility. So the facility expenses are exactly the same. Now we're generating more revenue in the same space, so our facility costs drop as a percentage of revenue. So now the amount available to compensate the veterinarians and to reinvest in the practice is about $929,000, or 36% of revenue. So while the revenue went up by about $565,000, or about 28%, the profitability improved by 51%. So it's definitely not a dollar for dollar, same percent increase. Some of your fixed expenses will stay at their current levels. So this is just a nice little way to assess how those changes that you're considering making in your practice will impact your practice and your profitability. And you can play around with this. Let's do some other what-if scenarios. Let's say that we've got the same number of doctors and the same, let's say now that we've got a 4-to-1 staff to doctor ratio, and same number of, or same average doctor transactions, same number of transactions, same number of active clients, same revenue, but now because we have more staff, let's say that the staff cost is $515,000. Let's assume that in our second what-if scenario, our average doctor transaction goes up by $20. Our active clients remain the same, so no change. And our client visitation increases by 0.5 times a year. So now our revenue is going to go up by about $688,000, which results in an increase of $541,000 in the amount available for doctor compensation and reinvestment. So this $688,000 increase represents a 34% growth in the profitability, but a 91% growth in the profitability. So huge, huge difference. Now obviously some of this growth in revenue is going to impact the doctor compensation if the doctors are producing at a higher rate, assuming that they're paid based on production, then the doctor compensation will go up as well. So this whole increase, of course, doesn't stay in the practice. We still have to pay the doctors out of this, but the key here is that we've got a significant improvement in the profitability. Let's click to the next tab, the expense changes. Now on this thing, on this worksheet, this page, the first thing that you see is the question, do you want to use the adjusted financial information from the revenue changes, so the what-if scenarios that we just went through on the revenue side? I'm going to say yes, we do. So the macros work, and you can see that it has pulled the revenue change information from the first page automatically. So now we want to go through the what-if scenarios on the expense side. So let's use the assumption that our variable expenses go down by 2%. And let's assume that the fixed expenses go up by 1%, and that our staff compensation goes up by 2%, and our facility expenses drop by 2%. Let's see what happens. So if our variable expenses go down by 2%, that means that our operating expenses will go down by about $54,000. If our fixed expenses go down by 1%, then our operating expenses will drop by about $27,000. And if our staff compensation goes up, I'm sorry, I entered that on the wrong line, didn't I? I want that on 2%, or an increase. Then the operating expenses will go up by about $54,000. And our facility expenses drop by 2%. And actually, I wanted the fixed expenses to go up too. Sorry, I've entered that on the wrong line. But you can see how easy it is to correct if you've made an input error. So now the net effect on the amount available for doctor compensation and reinvestment is that that will go up or improve by about $27,000. So the net effect, the results from the revenue changes on the previous page are amount available for doctor compensation improved by about $542,000. Our amount available for doctor compensation from the expense changes improved by $26,000. So the net effect is an improvement of $568,000. So now here's what our management statement looked like before the expense changes with just the revenue changes. Now here's what the numbers look like after the factoring in the expense changes as well. So overall, the improvement in the profit before doctor compensation is about $27,000 or 2%. Some things went up, some things went down. Now, if we want to look at the combined effect of these changes, let's click on the next sheet. And the question is, do we want to see the combined effects of the adjustments? Yes, we do. So click on yes, and again, this page is just all calculations, all formulas. So it automatically, the macros in the program automatically calculate the net effect. So the net effect of both of these changes the revenue changes and the expense changes, the net effect on the amount available for doctor compensation is about $568,000. So again, you can see how easy it is to just run through a variety of what-if scenarios. And you might say, well, why should we bother doing this? I think it's helpful for planning purposes to see, well, gosh, what if our decision in our strategic planning meeting was that we're going to take these 3 steps, and the net effect of that is going to be an improvement in our average doctor transaction, then following that through, what can we expect in terms of an improvement in profitability? So hopefully this will just make things a lot easier for you in calculating your numbers. Again, you could easily do this manually, but if you want to go through very many what-if scenarios, it really becomes cumbersome. And it's not always easy to determine, well, gosh, if my client visitation goes up, how does that impact my inventory cost? Or how does that impact my staff compensation? So we've really built those calculations into the program, and the assumptions that we used are listed at the bottom of the first and the third worksheets. So this is, again, we call this our revenue and expense change worksheet. It's one of the management tools that we'll be using in the Progress and Practice workshop at CVC in Washington, D.C. in May. So hopefully we'll see you there.